Hello and a warm welcome to Personal Finance. I'm Gugulethu Cele. Now today I'm joined in our Cape Town studios by Viresh Maharaj, who's the Chief Marketing Actuary on the results of the Sanlam Employee Benefits Benchmark Survey, which was released in the recent weeks. Viresh, thank you so much for making time to join us today. Perhaps if we take a look at an overview of what the results reveal with regard to retirement knowledge and retirement savings in South Africa, how dire do the figures look?
Thanks for the opportunity, Gugu. In this 35th iteration of the Sanlam Benchmark Symposium research, we found that South Africans are playing a high-stakes game of snakes and ladders with their retirement fund wealth creation. To put it in context, there are many snakes that can scupper an individual's ability to grow their retirement wealth, and many of these snakes aren't seen until too late. Unfortunately, there are very few ladders that help them to jump ahead of the curve. Like a game of snakes and ladders, you roll the dice and you can only move forward 1 to 6 blocks at a time, which is the case in retirement savings. It takes a lot of work over a long period to make it to the end of the board. However, through the board are a number of snakes, and these snakes can take you from point 99 to 0 if you're not careful with what you're doing. We've found that low rates of preservation, a lack of understanding of the tax impact of preservation, as well as the impact thereof on one's ability to create lifetime wealth, is one of those primary snakes. But it's not the only one. We've found that a quarter of South Africans only receive financial advice on the day that they retire. Now, by that stage, it's too late to make a meaningful, positive difference to their quality of lives in retirement, but it still can play a key role in helping to avoid making very poor decisions at that point in time.
Walk us through the theme of understanding the true value of one's retirement savings and how preservation also links into that particular concept.
So put very bluntly, we as South Africans don't value our retirement savings. It's clear in the research, it's something that we take for granted and assume is being done for us, and almost at every opportunity that we get, we dip into our savings and inhibit our ability to grow wealth. To put it differently, preservation effectively reboots your retirement funding journey. You go back to point 0 and have to start all over again, except there's one very, very clear difference. Time is not in your side. The most significant enabler of retirement fund wealth creation is the use of time through the compounding of interest to build that retirement wealth that will last you for as long as you can live. However, as South Africans, when we switch jobs, we tend to withdraw our retirement funds, spend it typically on reducing short-term debt or to fund lifestyle expenses, and then find that we start from rand naught when we go back into the workplace.
Given the changing dynamics with regard to different age groups, are we seeing that there's a particular trend with regard to how they approach their retirement savings, especially in light of the fact that so often these individuals are employed and often have group scheme retirement savings, so they often think that the benefit works for everybody in general?
A group scheme or a corporate retirement fund is a fantastic vehicle. It's a virtual tax haven, and with the change in deductibility up to 27.5, at wholesale prices, every individual should seriously consider making full use of the funding available to them through that vehicle. We have found that younger people and older people tend to view investment and savings differently, where young people in the research we've done have highlighted a preference for goals-based investing, and short-term goals at that. So they see a need to buy a car and that's what they save up for. Or they've got a holiday in mind and that's what they save up for. To that end, we found that the recent introduction of tax-free savings vehicles have proved particularly popular amongst younger people for a number of reasons. Firstly, they've been widely advertised, so it's created top-of-mind awareness as a savings vehicle. Secondly, there is a greater amount of flexibility with the tax-free savings vehicle than with many other of the vehicles around that provide similar level of tax deductibility. And thirdly, and I think this shouldn't be underestimated, is that a number of providers of these tax-free vehicles have enabled access to these vehicles via websites. So without the use of an advisor through a normal financial plan. And this is where younger people may be transacting on their own through these websites directly, as opposed to going through a full, proper financial planning process where the tax-free savings vehicle forms part of a portfolio and is not an end in itself.
That I take it then explains why it's important to have a full financial needs analysis to be done, and perhaps paint a picture of us, or to us rather, as to how often this needs to be done versus what was revealed in the survey.
A financial plan is like, we use the analogy of driving a car. Building retirement wealth is like driving a car from point A to point B. The issue is that for many of us, we don't understand where point B is, and even worse, we're not even sure where point A is. A financial plan can help you to put point A and point B in context, which is very important. You wouldn't set out in your car without having an idea of where you're aiming for. There's an old saying that if you don't know where you're going, you end up where you end up, and it could be anywhere. Having a plan in place helps you to take the decisions and put in place the structures that give you the best chance of getting there. It's not a guarantee that you'll get there, but you've got a much better chance of getting there with the plan than by leaving it up to chance. And this is where a proper financial advice and plan comes in, to give you a full insight into the context you're currently in, to identify what type of lifestyle you want in and through retirement, and then to give you the steps, not just the financial advice, but the lifestyle type steps that take you towards that retirement. And it's their job to be harsh. And it's a harshness that we tend to try and push away from, because we've become used to a certain type of lifestyle now, and then find that we don't have enough money left over at the end of the month to invest appropriately. For many of us, we take what's left at the end and then put it into our investment bucket, whereas that should be the very first thing we deduct from our salaries.
Well, that obviously highlights the key elements that we need to be looking for in our conversation with a financial provider or financial advisor. But when it comes to the all-important questions that we need to be asking our employers, as well as the heads of our HR departments, I understand you have about 7 suggestions on typical questions that we need to be asking. Give us an idea of what they are.
Google, what we found is that 1 in 2 people, so half of employees out there, seek advice or guidance from their HR. And in engaging with HR professionals, we found that while they've got the appetite, they see the reason that they've been asked these questions, they simply don't have the capability to answer financial questions. And that's where individuals need to ask the right questions of their HR, because HR wants to help, but we've got to ask the right questions. It's not about asking them for financial advice, because in fact they're not allowed to give financial advice. What we should be asking is factual information, such as, where do I get access on my fund value from? Am I getting a fair deal for what I'm paying? Do I have insurance through my employer, and for what and how much? These are simple, basic questions that your HR should be able to give you. And it's with these answers to these questions, you can start to build a context around your point A, to figure out where you actually are at that moment in time, and to then also ask the question, does my fund have a targeted income in mind for me and for myself in retirement, to give you an indication of whether or not your fund has a point B in place as well.
Viresh, given the results of the survey and the key elements that they highlight with regard to the snakes and ladders game, what fundamentally then should employees like myself and employers out there in the industry be learning with regard to how we need to fix our relationship, if I can refer to it as such, when it comes to understanding more about our retirement savings?
First off, it's your savings, it's your money. If you had to find that money was being taken out of your bank account each month and you didn't know where it was going, you'd have an issue. This is in fact your money. Every single cent in your retirement fund is 100% yours. So the best advice that we can give you out of the survey is simply to get started. Understand what's there and get started in learning, get started in questioning, get started in taking ownership of your individual retirement journey. It's in fact up to you to make the biggest difference. You can have the best advice, the best employer, the best structures out there, and the employees are really good, advisors are really good, and the structures are in place. But it's up to you, the individual, to take ownership of this journey. To use an example from Google, who have been looking at self-driving cars recently, they found that 94% of accidents in the United States are due to human error. And in a very similar manner, we believe that the majority of errors in the retirement funding journey of members come down to the member making poor choices due to a lack of awareness of the choices available and the consequences of the decisions that they're making. And the only way to really change that is for the individual to get started.
Exactly. Well, we've certainly said quite a bit. Let's get a quick recap now of the key takeaways from tonight's discussion. Viresh, you've clearly highlighted the pros and cons that are seen in the environment when it comes to the lack of knowledge for retirement savings in South Africa. But what are the key elements that we need to take away from the Sanlam Employee Benefits Survey?
Very simple. Get started, preserve, contribute as much towards that cap of 27.5 as possible, and short of investing in cash, investing in almost anything else will get you closer to your retirement funding outcome, given that you've got a long enough time period. So don't overcomplicate it. Just get started and do something, because doing something that works is better than doing nothing that's going to guarantee you failure.
Exactly. To sidestep for a moment, Viresh, what about the changing landscape? I know that earlier this year there was a lot of noise with regard to a change in retirement reforms. Is that something that we also need to be including in our conversations with our financial service providers?
In fact, it's one of the key elements of change that have been brought through by National Treasury. For instance, this change of increasing the tax deductibility for all employees up to 27.5% is a very, very good thing. It provides you with an increased opportunity to benefit from the deductibility within your funds. I mean, I've done a quick analysis. Assuming that you've got 20 years to retirement and you're contributing the average, which is around 18%, given the benchmark research we found, by taking that 18% up to 27.5%, you increase your retirement fund value by more than 50% at retirement. And that makes a material difference. And that's a direct result of government making a change that enables us to fund better. Regarding annuitization, unfortunately, many of us don't make the right choices come annuitization. The research has shown that 5% of members out there, or 5% of pensioners, believe that they have bought a living annuity. Now, this is important because the actual number of, or the actual proportion that have bought living annuities is closer to 80 to 90%. This disconnect means that we've got pensioners out there, the majority of pensioners out there using living annuities, but most of them believe that they're in guaranteed annuities. And this disconnect is very important because these structures are vastly different in the risks that they contain. Managing your income under the assumption that it's a guaranteed annuity is a very dangerous place to be when in fact you've purchased a living annuity because you've taken on the longevity risk that you believe has been outsourced to the insurer, which is simply not the case.
Exactly. All the more reason for us to have you back on the show again to decipher some of these challenges for us in the retirement space. A big thank you once more to Viresh Maharaj, who is the Chief Actuary at Sanlam Employee Benefits, for joining us this evening. Now remember that we want to hear from you, so share any of your thoughts, insights and commentary to @CNBC Africa using the hashtag Finance410 or to myself @Gugulethu. Until next time, have a wonderful evening.